on the definition shown, MFRS 134 refers to a financial report prepared for a period shorter than a full financial year. It can be presented as either a complete set or a condensed set of financial statements. In practice, these reports are commonly issued on a semi-annual, quarterly, or monthly basis. Moving on to the objective, MFRS 134 prescribes the minimum content of interim financial reports, including required disclosures. It also identifies the recognition and measurement principles that should be applied when preparing this report. This ensures that the financial information is consistent and reliable for users. Next, this slide explains the minimum components of an interim financial report. As stated, the report requires either a full set of financial statements in accordance with MFRS 101 or a condensed version. The components include statement of financial position, statement of profit or loss and other comprehensive income, statement of change in equity, statement of cash flow, and selected explanatory notes. These elements provide a summary of the company's financial performance and position during the interim period. On the right side, we have the basis of preparation. There are two methods. Number one is the integral method, where interim reports are prepared as a fraction of the annual report. And number two is the discrete method, where reports are prepared on a periodic basis, treating each period separately. Both methods guide how financial information is recognized and reported during interim period.
One significant event affecting KPJ Berhad financial position is the strategic divestment of its non-core overseas asset, particularly its aged care business in Australia and its operation in Indonesia. By exiting these loss-making foreign subsidiaries, the group recorded a substantial gain from discontinued operation, which significantly boosted its net profit after tax to 407 million ringgit for the 2024 financial year. This transaction reflects a major shift in the group's balance sheet, moving away from underperforming international assets to focus resources on its domestic integrated academic health system, thereby improving the overall quality of its earnings. Furthermore, the group financial performance was significantly influenced by a substantial increase in capital expenditure dedicated to digital transformation and infrastructure expansion. During the 2024 reporting period, KPJ increased its capex to 406 million ringgit, a 66% rise compared to the previous year. This transaction was primarily driven by the implementation of the KPJ health system and the modernization of its hospital network. While this resulted in a large outflow of cash, it directly contributed to a 50% growth in annual revenue, signaling a strategic reinvestment into the company's core operation to enhance long-term service delivery and operational efficiency.
Next, I will explain the current and comparative periods used in this report. The financial year is divided into 4 quarters. Quarter 1 covers January to March 2025, Quarter 2 covers April to June 2025, Quarter 3 covers July to September 2025, and Quarter 4 covers October to December 2025. These quarterly periods are important because they help in preparing interim financial reports and allow performance comparison across different time periods. This slide shows the period used for the interim financial report, comparing the current year 2025 with the previous year 2024. For the statement of financial position, the date used is 31st December 2025 for the current period, 31st December 2024 for the comparative period. For the statement of profit or loss and other comprehensive income, it is divided into the quarterly period, which is October to December 2025, compared with October to December 2024. The year-to-date period is January to December 2025 compared with January to December 2024. For the statement of cash flow, the period is January to December 2025 compared with January to December 2024. And for the statement of change in equity, the date used is 31st December 2025 compared with 31st December 2024. This structure ensures consistency and allows users to clearly compare financial performance between the 2 years. As you can see, these are the company's financial statements, including statement of financial position, statement of profit or loss and other comprehensive income, consolidated statement of change in equity, and last one is statement of cash flows.
Moving on to part B of our presentation, we'll be diving into MFRS 8, operating segments. Understanding this standard is crucial because it dictates how a company breaks down its complex financial data into smaller, more manageable pieces for stakeholders to analyze. So what exactly is an operating segment? According to the standard, it is a component of an entity that meets 3 specific criteria. Firstly, business activities. It engages in activities where it earns revenue and incur expenses. This includes transactions within the same entity. Secondly, management review. Its operating results are regularly reviewed by the entity's Chief Operating Decision Maker, CODM. It is intended to make a high-level decision about how resources are allocated and to assess performance. Thirdly, discrete information. There must be a specific, separate financial information available for that segment.
The third, Chief of Decision Making, which is CODM, is a key concept under MFRS 8, which operates segments and identifies a function, not necessarily a manager with a specific title. That function is to allocate resources to and assess the performance of the segments of a public entity. Often, the CODM of a public entity is its Chief Executive Officer or Chief Operating Officer, but it may be a group consisting of, for example, the public entity's president, executive vice president, and others. The title or titles of the person identified as CODM is not relevant as long as it is the person responsible for making strategic decisions about the entity's segments. The example of CODM in KPJ Healthcare Berhad are Shin Kek Chuan, which is the board of director. He manages the business and operations of the group and implements board decisions. Next, Dr. Muhammad Farid bin Salim, which is Chief Operating Officer. He is responsible overseeing all operational aspects of KPJ Healthcare, placing a strong emphasis on supply chain management and customer service.
KPJ Healthcare Berhad adopts geographical segment reporting as its primary structure. This allows the management to address different regulatory environment and economic risks across its location. According to the 2024 Integrated Report, the group categorized its operation into 2 main areas, Malaysia and others, international. The Malaysia segment remains the core pillar of the company. In 2024, it contributed a massive external revenue of approximately 3.85 billion ringgit and holds assets worth over 7.3 billion ringgit, indicating a very stable concentration of capital in the local market. In contrast, the other segment, which includes operations in Thailand, Bangladesh, and Australia, recorded a much lower revenue of about 71.5 million ringgit and faced a loss before tax of approximately 13 million ringgit. This highlights the operational challenges abroad compared to the strong 561 million ringgit profit generated in Malaysia. This report is further strengthened by separating discontinued operation in Indonesia and Australia, allowing the management to focus on the performance of current sustainable markets. The primary business segment is healthcare services. This covers a complete medical range, including the operation of private specialty hospital, diagnostic services through labs, and the distribution of pharmaceutical products. The second segment is support and education services, which includes KPJ Healthcare University and the sale of hospital merchandise.
This shows that KPJ has successfully diversified its income beyond just patient treatment. To measure success, the group used EBITDA. For example, the Malaysia segment recorded a strong EBITDA of nearly almost 1 billion ringgit, ensuring the management can accurately compare efficiency between its hospital wings and educational arms.
Now that we know what a segment is, let's look at why we report them. The first major benefit is better risk assessment. Segmental reporting allows users to peer under the hood of a company to identify where the real risk lies. Instead of seeing one consolidated profit figure, we can see which areas are thriving and which are struggling. If you look at the table on the slide, we have a real-world comparisons between geographical segments, Malaysia versus others. The Malaysia segment shows strong, stable revenue. However, the other segment is actually a loss-making and contributes a very little revenue. Without this breakdown, a shareholder might think the entire company is performing well, but through MFRS 8, we can identify that the company might be overly dependent on the Malaysian market and is facing potential losses in its international or secondary operation. This transparency allows investors to assess whether the company's risk profiles align with their investment goals.
Next, improve decision making. Segmental report provide detailed information about different parts of a business, allowing users to understand how each segment performs, evaluate where to invest and allocate resources. Based on segmental reporting of KPJ Healthcare, revenue from external customers is heavily concentrated in Malaysia of RM3,853,949 compared to others of RM71,415. Finance costs and depreciations are also broken down by segment, showing where expenses are higher.